Hi there, welcome to Kneppy Invest. Time for a technical and portfolio update. I have been doing these videos a little bit over the past few weeks, but focusing on the portfolio. Today's video, I'll be focusing on technical updates, looking at charts of quite a few companies. I have about 15 companies on the list, maybe even more than that. Also have a look at the XJO and the Nasdaq, and apparently it was the worst week on the ASX for a year. We'll be able to confirm that when we get to the technical update part of the video. But before we get there, just want to do a bit of a portfolio update. I have three portfolios: a long-term portfolio, a medium-term portfolio, and a short-term portfolio, which is my trading portfolio. So we want to see how these three portfolios are performing right now. My long-term portfolio is up 2.2% compared to the benchmark, which is actually down now because of the bad week, down 0.5%. And my long-term portfolio has actually also received some dividends, $26 of dividends through three companies: ResMed, Apple, and Microsoft. Best performing companies, I'll list the first five here: Nick Scali, Clinuvel, Breville, REA Group, and Ballador. And the reason why Nick Scali is the best performing company in this portfolio is because there was a positive reaction when that company released their full year results. Worst performing companies, I believe, are Shopify, and that is on the New York Stock Exchange. And I just intend to hold that company for as long as possible because that's all about online shopping. And that is, in my opinion, I could be completely wrong, I believe online shopping is just going to explode over the next 5 to 10 years. So happy with the performance of my long-term portfolio. And I really expect this to significantly outperform the benchmark, significantly outperform the ASX 200, simply because I don't own banks, don't own those big companies on the ASX that, to be honest with you, don't go much higher or won't go much higher than they are now. Onto my short-term or medium-term portfolio. This consists of companies that are not high quality. So my long-term portfolio is mostly consistent of companies that I would consider high quality, companies I want to own for the long term. Medium-term portfolio is those sort of companies, or consists of those sort of companies, I hope, or I maybe not expect, but I think there is potential these companies could become high quality companies in the past. Now, the way to really magnify your returns is to hold those companies that transition from a low quality company to a high quality company. That period of time when a company goes through that transition is when you see maximum returns. And possibly some of these companies are moving in that direction. So the medium-term portfolio up 3.4%, which is significantly higher than the benchmark. The best performing companies in this portfolio include Enserata, Duratec, DUG, Chryso Corporation, which actually went to the trading halt because the share price has just zoomed up higher, Energy One, EZZ Life Sciences. So you'll notice most of these companies are much smaller than those big companies on the ASX. So there's going to be a lot of fund managers who won't even have heard of some of these companies. But if they can keep on growing over the next 5 to 10 years, eventually those fund managers will start buying these companies. Worst performing company in this particular portfolio include Frontier Digital, Xtech, Mount Gibson, Ventura Health, and LGI. Now, a lot of these companies I don't really want to trade. So I'm not really looking at the charts. This is just a medium to long-term hold in the hope, in the belief that some of these companies, not all of them, but some of these companies will eventually become high-quality companies. And to be honest with you, these are the sort of companies I favor. If I only had one portfolio, one trading strategy or investing strategy, I probably would pick this portfolio using this sort of strategy. Now, onto the short-term portfolio, which is a trading strategy. So in this strategy, I look at charts. The other two portfolios, I don't look at charts all that often. I will look at them on occasion, but I don't focus on the charts. I won't make decisions based off the charts. In this portfolio, I definitely will look at charts. And this has been performing really well, up 8.6% compared to the benchmark, down 0.5%. So you might be saying, I should be focusing on this strategy. But in this strategy, you need to be fully focused every single day, in my opinion, in not only every single day, but through the trading day, you have to be focused on charts and how the share price of these companies are moving around. So it's a little bit more stressful, a little bit more time consuming as well, but it is working right now. Now, I have made a few mistakes in the past week, and thankfully those mistakes haven't hit me too hard. The two worst performing companies in this particular portfolio are, well, one of the worst performing companies and the fourth worst performing companies are the mistakes I have made. Star Entertainment Group, the company released some favorable news about 1 week ago, and I thought the market would react really well to that news. It hasn't quite. In fact, share price has fallen. And ResMed. One thing I've learned about ResMed is even though the share price I thought might bounce, and it did bounce a little bit, that bounce was not long-lived. So more than likely, I will sell out of these two positions to limit my losses. Best performing companies in this particular portfolio, Nuix, which I've already sold out of, they released their half-year results or full-year results, and share price actually has pulled back a fair bit. SG Fleet, which I have transferred from a medium to short-term because I am just trading this company. Megaport, I'm still owning Megaport, still owning Smart Group, which are also transferred from a medium to short-term because I am trading that. It's just a trade based off the chart. Also, I have Electro-Optic System and Service Stream. I've also taken a position in MA Offshore a few weeks ago based off their full-year results, and the chart looks absolutely beautiful for that company. So overall, really satisfied with how the short-term portfolio is performing. But again, I probably wouldn't do this strategy and have this portfolio if I didn't have enough time to follow the market every single day. Not only every single day, but every single, maybe not every single minute during the trading day, but definitely every single hour during the trading day. So potentially, if I was completely retired, that sort of thing, maybe I would be only using this sort of strategy. Now on to the charts. And if you have any questions about these portfolios, just leave me a question in the comment section of this video. I do have some plans moving forward for how I'm going to do these type of videos and what platform I might release these videos on. Now onto charts. First step is the XJO. So I did hear, maybe I think it was yesterday or late on Friday, that this was a worse week for the XJO or the Australian markets for a year. So let's have a look. So even though it was a worse week, it still doesn't mean we're in a downtrend. In fact, the XJO is just going sideways. It's been going sideways for about 2 years, but still in the training range. So we've had this upwards moving training range since the GFC, and we're still in it. The only time the XJO has fallen out of this training range was during the COVID-19 financial panic, and then it rallied really quick to get back into the training range. We also saw it go briefly above it for a very brief period of time in August of 2021. You can see it just went above it for 1 week and then pulled back below it. So in the past week, the XJO was down 2.6%. Now, if we go back to March this year, it was down 1.9%, down 2.1%. We've also seen it down 2.1%, 2.2%, so nothing like 2.6%. If we go back to September last year, 2.4% down, 2.3%, and then in August, late August, down 3.9%. So yes, 1 year ago, this is the worst week for 1 year on the XJO, but doesn't mean anything. We could have a really good week next week. Who knows? Anyway, nothing like the COVID-19 financial panic when the XJO was down 13%, 11%, 3.5%, and 9.8% in 4 consecutive weeks. Now onto the Nasdaq, and one of the reasons why we probably had a pretty bad week on the ASX is because of the American markets. Nasdaq has had 3 down weeks, but it's still in an uptrend. So just because it's had 3 down days in a row doesn't mean we're in a downtrend. Doesn't mean we're in a bear market. In fact, if you look at the daily chart, a little bit of a pullback, but nothing to be concerned about just yet. The reason I wouldn't be concerned about the Nasdaq pulling back, it's a very healthy pullback. We always see these pullbacks in bull runs or bull markets. So if we go back to, say, 2021, we saw the Nasdaq have 3 down weeks in a row and then started to go higher. It's just a little pullback. We saw it again in August or September 2020. And even in the COVID-19 financial panic, that was not the end of the uptrend. The Nasdaq has been in a weekly uptrend for a long, long time. It was looking fairly dicey back in late 2022, but still in an uptrend. But If you go back through history, these little pullbacks are fairly common, 3-week pullbacks, fairly common through history. Sometimes they're 4 weeks or 5 weeks, but usually after 3 or 4 weeks, you'll see this Nasdaq start to rise again. The only period of time was during that little bit of weakness during 2022, when it did look like there was much more bearishness in the Nasdaq. But right now, this is just a healthy pullback, in my opinion. Now on to individual companies charts. Quite a few to get through here, so hopefully I won't spend too much time on each individual company, because I don't want this to be a 1 hour long video. More than likely it will be. Now, I did make one purchase in my short-term portfolio, and that was GUD Holdings. They released their half or full-year results, and the full-year results were pretty good. The market loved it. Share price up. Share price up 14.9% on the day. And the share price actually had moved into a nice uptrend before the release of the results. We had a nice pullback in the share price the following 3 days, and that's when I took a position on the pullback. We can see that pullback when we look at the 1 hour chart. Beautiful pullback in the share price, and I took a position. Looks like it was the first hour of trading on Friday. Share price got down to about 11.20. And I bought on that pullback, right? I think it was $11.20. I bought some shares. And share price actually rose during the rest of Friday. So a nice little pullback on lowering volume, and we've seen share price rise again. So 1 hour chart looks absolutely beautiful. The other important thing to note when it comes to GUD Holdings is the last time share price was this high is way back in June 2022. So we're talking about a 1 year high in GUD's share price. I don't think the valuation of this company is not too stretched. The dividend yield 3.3%, price earnings 16.3. I'm not sure if that price earnings is based off their full year results for financial year 23. Now to another company I actually do own in my long-term portfolio, CSL. I am willing to trade this. I have traded this over the past few years, and I've bought shares in this company when they're down like $260 and then sold about $300. If you look at the daily chart, there was a really good pullback in the share price because of a bit of weakness. They released a negative report. Now, the main reason they released a negative report negative update was because of currency issues, exchange rates, that sort of thing, which I think the market a little bit overreacted. They released their full year results, and I think the results were a little bit better than expected. And the main reason I have put CSL into this video is because when you look at the 1 hourly chart, I think there is potential of a short-term movement in the share price. Not only that, I'd be willing to pay $270 right now for CSL shares in the belief that the share price will eventually rally back up to $300. So a nice little 10% return in CSL if you're able to buy shares at $270. Now to another company I own in my long-term portfolio, PWH Holdings. I believe after this, every other company I'll be showing you, or any other chart I'll be showing you, are companies I don't own. So this is the last of my holdings. Now, I own this company for the long term, but I'm always willing, when I see the opportunity, to buy some more shares in a company. And this is another opportunity to add to my position in PWH Holdings. I am very bullish about the future of this company, and they released their full year results after the end of trading on Thursday, and the share price or the market really reacted well to their full year results. So it was interesting to see this reaction. I don't know why. If you look at the daily chart, I don't know why the market had become bearish on this company, because this company is moving places. Now you might say, because this company, if you look at what they do, they sort of a cooling system. So engage in design, prototyping, production, testing, validation, and sale of advanced cooling products and solutions to motorsports. So they are more renowned for their cooling solutions for F1, and they are expanding rapidly into alternative areas as well. So diversifying, and that's why I'm fairly bullish on this company, just that diversification. Anyway, so they released their full year results, and just based off the market reaction, I'm liking how it's happened. So what's happening here? So the other thing I didn't mention with GUD is a really good volume coming in. So you can just see massive volume coming in. This is a 1 hour volume. So if you compare that 1 hour volume after or from when they released their full year results to the last month or so, much higher volume. And that means fund managers are getting excited about GUD holdings. And you want the fund managers to get excited because they're the ones who eventually will drive the share price higher. Same thing is happening with PWR holdings. Really good volume coming through. Share price has popped up, broken out. I would define this as a breakout, just looking at the 1 hourly chart. The other thing I am going to do a little bit more often is I do want positive momentum behind the share price. It's one of the mistakes I made with Star Entertainment Group. Even though they did release a positive announcement, there was such negative sentiment behind the company that no matter how good the announcement was going to be, there will be selling. There will be those shareholders who don't care whether that announcement is positive. They just want to get out, and they saw the opportunity to get out. So could say the same thing about PWR holdings, but I think there's going to be more faith. I wouldn't say there's negative sentiment behind this company. And the last time the share price was this high, it wasn't that long ago, only May of this year. So I wouldn't say this is like GUD holdings. A little bit more faith in GUD holdings simply because the share price is at more than a 1 year high. We can't say the same thing with PWR holdings, but I'm probably more bullish about the future of this company than GUD. Now, onto companies I don't own in my portfolio, but I am following. The first company is Lindsay Australia, which has been performing very well. But this looks like it could be a double top. So not only does it look like it's a double top, the share price is right at the neckline. So yeah, double top, this is almost looks like a classic double top. Share price pulled back after the first top down to around about $1.10. Share price is now right on $1.10, so it's right on that neckline. If it falls below $1.10, I think this double top will be confirmed. I need to see it below it for a few days at least. So a potential double top. This is a bearish signal. So this isn't my buy opportunity. It's if you are a shareholder, just be wary that this could be a sell signal, particularly if it pulls through or below $1.10. So Lindsay Australia. So I saw this pull back to $1.10. So I was getting a little bit excited that is a potential with a share price at a nice little support level, potential buy. But then I saw it was a double top and I went, oh, I'm going to stay out of that one. Double tops can be quite... So when you talk about signals like this, they're not always 100% effective or right. So there is a probability behind it. So say maybe 60 to 70% accurate in their forecasting ability. So just because it does look like a double top, just because the share price is right on that neckline or that support level doesn't necessarily mean the share price will fall below $1.10. At the very least, the share price looks like it is going sideways for now. So because the share price really struggled to get above that old high. Now on to Telstra. Company I don't follow that closely. This is a low-quality company on the ASX. And the reason this is a low-quality company, you might be surprised that I say that. Look at the revenue growth of this company over the past 10, 15, 20 years. There's no revenue growth. In fact, revenue is going backwards. Dividends probably going backwards. Low return on equity, low return on invested capital. I have heard some people say that this company could grow over the next few years, but for some reason, the market didn't react well to their full year results. So 2 big down days in a row. Share price has fallen from $4.25 to $4. So you might not say that's a big drop in share price, but for Telstra, that is a big drop in share price. And if you look at the 1 hourly chart, this looks fairly bearish. So continued selling. Share price had moved into a downtrend, a 1 hour downtrend before the release of their full year results. Some high volume coming in as well. So bearish when it comes to Telstra. If you look at the weekly chart for Telstra, I like to look at all time frames. That was a bad week. So over the whole week, share price of Telstra down 6%. So that was maybe the worst week for Telstra since August 2020. August 2020. Worst week for Telstra since August 2020. Now, if you look at the weekly chart, you'd say this is maybe a buy the dip opportunity, just based off the weekly chart. So you can get different outcomes, different thoughts when you look at the different time frames. So 1 hourly chart, this looks fairly weak, fairly bearish. Look at the weekly chart, looks maybe a potential buy the dip opportunity. It all depends on your time frame. Now, someone did mention or want or request, I do a video on Appium Animal Health. This is a profitable company with a dividend, but the share price has pulled back significantly on something. I haven't really followed this company all too closely. Look at the daily chart. Share price has really nosedived over the past few weeks, dropping from 50 cents to 36 cents. Not a lot of volume at all. But when you look at the 1 hourly chart, in the last hour of trading on Friday, the share price for this company dropped 12.5% in 1 hour on a huge volume compared to the rest of the 1 hourlies going back to April. So this could be just one person dumping, one fund manager dumping. But the reason I've included Appium Animal Health in today's video, remember, this is a profitable company. Don't think it's growing all that quick. It is growing. Revenue has increased from $61 million to $93 million. Dividend yield of 4.4%, price earnings ratio 10.9. The reason I've included this video or this company in this video is when you look at the weekly chart, you'll notice the share price low during the COVID-19 financial panic was right on 33.5 cents, so 34 cents we'll say. Share price right now for this company is around about 36, 35 cents. So the share price is at a long-term low, right on a long-term low. In fact, the COVID-19 lows. So sentiment of this company is fairly similar to the negative sentiment we saw during the COVID-19 financial panic. In fact, when you look at the weekly chart, share price of this company fell all the way through from 2016. Share price was $1.80 all the way down to 30 odd cents, 35 odd cents. So an opportunity here, potentially, this is a double bottom. Now, there's a big difference, a time difference between the first bottom, which was in March 2020, to this bottom, which was over 3 years later. So I'll keep my eyes on Appium Animal Health. Anyway, next company is Charter Hall Long WALE. I did a REIT video featuring this company, and one of the main reasons I decided to look at Charter Hall Long WALE, or included in this video, is when you look at the weekly chart, you'll notice, because this company listed back in 2016, when the share price gets to, say, $3.60 or so, we see buying coming in. So the low, all-time low for this company is around about $3.60. So we saw the lows, a first low back in 2016. We saw another low in 2018. During the COVID-19 financial panic, we saw the share price really pop up after the share price went below $3.60. And now the share price of this company is at $3.53. So this is an all-time low for this company. However, in saying that, when you look at the daily chart, when the share price hit that all-time low, we saw a nice, well, actually, it's not a nice little bounce. We definitely saw a bounce. So more than likely, there were some investors who knew that was an all-time low. You can definitely see this on the 1 hourly chart, who knew that was an all-time low. And over the next 2 or 3 days, the share price went from $3.60 back up to about $3.74. Not a lot of volume, but that bounce failed in the end, because the share price went back down to that support level and then fell through it, and fell through it fairly easy. So that support level has been broken. This all-time low has been broken, and a lot of negative sentiment in this company, or this REIT right now. Some questions about maybe not the long-term viability, but definitely questions about whether they're going to have to sell some property on the cheap because they need to raise some funds, because maybe some of their debt covenants are going to be breached fairly soon if their property gets revalued downwards by a significant amount. Now, on the converse, now might be a time to think about buying some of these REITs, because we're at multi-year, if not all-time lows. So these REITs are starting to look a little bit interesting at the moment. Now, it's a company I don't own, have never owned, and maybe why not is the question. This is Reece Limited, plumbing, stuff like that. We'll start with the weekly chart. This company looks pretty good. Share price has been as high as $28 back in 2021. So more than likely, their market was getting a little bit too excited about this company. A nice little pullback all the way down from $28, all the way from $28 down to $13. So share price more than halved in a fairly short period of time. But in saying that, when you look at the daily chart, the share price is in a beautiful uptrend. Moved into an uptrend back in March of this year, and we're not seeing a real rapid rise in share price. This is a nice, smooth order uptrend. A nice little pullback, late June into early July. That was a nice time to take a position in this company. But definitely, this is a beautiful looking chart on the ASX. Last time the share price was as high was way back in March of 2022. So we're talking about an almost 18-month high for Reece Limited, and the 1 hour chart just looks as spectacular as the daily chart. So I've been following this company for a while now, for about 6 months, and I have not taken a position, a trading position in this company. Now to Mass Group, and we've seen a fair bit of volatility in this company. You can see that volatility when we look at the daily chart. It's going up and down. You might be saying the share price of this company is trading in a range. I don't think the market really knows how to analyze this company. So sometimes it's a little bit too optimistic, sometimes a little bit too pessimistic, and we've seen that sort of swing in sentiment in this company happen about 3 or 4 times just in 2023. And right now, I think sentiment has shifted to more positive. Company released their full year results and the market liked it, and that's why the share price is zooming higher. And when you look at the 1 hourly chart, this looks like a nice 1 hourly chart. Unfortunately, share price is moving into a nice little resistance zone because the share price was at these levels back in May, June of this year, and there will be some investors who want to get out. So potential resistance for the share price to move higher from here. But if the share price can get above $3.45, get above the previous lows we saw back in May, that would be a fairly bullish sign moving forward for Mass Group. Now to a company I have owned in the past, but I don't own now, and that's Technology One. This company is in my high quality watch list. This is a watch list where I just have high quality companies that I want to own. That's the most important thing about that watch list. High quality companies I want to own. This company is in that list. Now, there are questions about the valuation of Technology One. I would be listening to those who say Technology One, based off the growth, potential growth, this is quite overvalued. But there is a premium to this company because Technology One is without doubt a cult stock on the ASX. And cult stocks on the ASX tend to be significant, maybe not significantly, but they tend to be overvalued and overloved. So what you want to wait out for when it comes to Technology One is a nice pullback in the share price. And we are seeing Technology One in a pullback. This is maybe the start of a significant pullback. I don't know. Now, if I just draw a line from the last lows, well, the last low has already been broken. But if we go back to the lows before that, which was in May, share price has or Technology One share price is right on that low. But when you look at the daily chart, the share price is still in an uptrend. Now, one of the problems is the high was in May. So share price has been falling for about 3 years, and you don't want to see a big time difference between that high and the next high. So I think there is potential that at the very least, Technology One share price will go sideways from here. The main thing I'm looking for Technology One is how low the share price can drop from here. If the share price dropped to $10, I would be taking a position in this company. I made the mistake last year when the share price did drop to $10. I did not take a position. This was a potential buy that I didn't miss. I won't say I ignored it, but it did drop to my buying price and I just didn't follow through with my plan. And I sort of regretted it because that was the low, almost the low of the share price. So if the share price can get down to $10, I would be automatically buying this. I don't think it will. At this point in time, I don't think it will. If the share price fell to $12.50, that's when I really would start thinking about taking a position in this company, even though I probably would say this company is overvalued. My bigger mistake when it comes to Technology One is selling this company when I had a position in this company way back. I think I bought this company back in 2013 and sold it. Was it 2018, 2019? I should have just kept holding. This is a high quality company. I should have just kept holding. I sold because I thought it was overvalued and the share price might pull back. Silly mistake. Rookie mistake. I wouldn't say a rookie mistake, but it's a little change in the way I deal with high quality companies now. Back then, I was willing to take profits. Now I'm much less willing to take profits. Now to a company I have argued that hasn't shown me that it can be that has been a high quality company doesn't mean it won't be a high quality company in the future. Now, car sales is showing me they have the potential to be a high quality company moving forward. Unfortunately, I think the market is seeing the same thing. The company did release some really good results. You can see this is a weekly chart. Share price is at all-time highs. Now, I did put a buy for this company. The buy price has not been hit. Look at the daily chart. Beautiful, beautiful chart. And the 1 hourly chart. The buy point for this company was in the first hour upon release of their full-year results. Share price actually pulled back to $20 or below $25 for a very brief period of time. Really high volume, not only on the day of the release of their full-year results, but continuing high volume over the next few days, which tells us fund managers are loving this company right now. We saw another little pullback. This is when I should have taken a position on Thursday when the share price pulled back to $26.60. My buying price was a little bit lower than that, so I shouldn't have put in a bid that low. That's my one mistake with car sales. I should have been as, what's the word? I shouldn't have been as conservative. I was thinking maybe the share price would pull back a little bit lower, but when I saw that pullback, I should have taken a position and started trading on the Thursday, and the share price has continued its upward momentum. So another miss there when it comes to a potential buy for my, I would have put this into my short-term portfolio because this would just be based off the chart, not off anything else. So yeah, anyway, so just because you miss an opportunity doesn't mean you should regret it. I don't regret taking a position in this company because there's plenty of opportunities, not only right now, but there's going to be plenty of opportunities in the next few weeks to take short-term positions. Is one of these potential companies Hansen Technologies? Main reason I've included Hansen Technologies is when you look at the 1 hourly chart and daily chart, looks like there is potential that Hansen Technologies is moving into an uptrend. Share price has moved beyond, above the highs we saw back in late 2022, early 2023. So a potential breakout in the share price. I don't think this company has released their full year results. I can't remember seeing it. So maybe the market is expecting some good results from Hansen Technologies. This is another company that I think is borderline high quality, another company I don't own, but I will be willing to own this company. Now, if you do look at the weekly chart, you'll notice the share price of Hansen Technologies has done nothing over the past 2 years or so. And yeah, so whether this is the start of a new uptrend remains to be seen. There's been potential new uptrends a few times in the past. Now, on to Nuix. I have traded this over the past month and a bit. Successfully traded, thankfully. Maybe I sold out a little bit too soon. This company also released their full year results, but the market reaction was bizarre. Share price dropped 8% in the first hour. In fact, when the share price opened higher after the release of the full year results, and then they were selling in that first hour, a fair bit of selling, and that selling has continued. But the main or most important thing is that selling has come to an end. Share price is now going sideways. So maybe the low has set in at around $1.40. So I took profits in Nuix at around about $1.44, if I remember correctly. So I could buy back in at $1.40. I was thinking about taking a position when share price got down to $1.30, and then the share price went and zoomed higher. So another potential buy here for Nuix. Cochlear. This looks pretty good. This looks really good. We'll start off with the weekly chart. I probably would argue that this is another company, just like car sales, that I have not seen signs that this has been a high quality company in the past. There are some red flags in regards to Cochlear, mainly regards, I think it was to revenue growth, that sort of thing. But the share price has zoomed higher in the past week, probably on the back of their full year results. Share price up in the week, up 11.9%. Not only that, I think we might be seeing an all-time high for Cochlear. Yes, an all-time high for Cochlear, which does not, what's that word? Dissuade me, maybe the word I'm looking for. Dissuade me from taking a position in the company. Some investors will be dissuaded from taking a position in the company if the share price is at an all-time high. Well, that's ridiculous. When the share price is an all-time high, there's no resistance from the share price going higher. higher. Now, you might say on valuation grounds, it's ridiculous taking a position when a company is an all-time high. But for a company to go from all-time high to an all-time high to an all-time high, there has to be some good momentum behind it. And you want a company who keeps going or getting all-time highs, because that's the ultimate goal, is for a company to keep on growing its business, its financials, and also its share price. Anyway, so it looks like the company did release some good results. Share price looks pretty good on the daily chart, the weekly chart, and the 1 hourly chart just zoomed higher, again on really good volume. You want to see that increase in volume. Now, I probably would say this company's overvalued. Price earnings ratio 55. Do they have the... Yep. In fact, we can look at the annual report. So, revenue almost 2 billion, profit 300 million. Profit last year was 289, so not much of an increase. So maybe it's their guidance, which has caused the market to get excited in regards to Cochlear. Next two companies are sort of related, Sigma and EBOS. So Sigma won a contract through with Chemist Warehouse that was with EBOS. So that's why we saw Sigma Pharmaceutical Healthcare, what are they called now, zoom higher. This was on the 6th of June. Now, the share price, there is a nice little support level at 75 cents. That 75 cents was set in that first hour. That was a low in that first hour. It's touched, the share price of this company has touched 75 cents after that first hour. Once, twice, 3 times, 4 times since, which means there's a little bit of strength. And when I say strength, I heard someone say the more times the share price hits a resistance or support level, the weaker that support or resistance level gets. On the complete other view, I think the more times it hits, the stronger it is, because it's sort of like a self-fulfilling prophecy with traders. They see it hit that resistance or support level a few times, and they say, well, if the share price gets to that level, I will either sell or buy shares. And that, it seems like that's what's happening with Sigma Healthcare. But I would say every single time it bounces of 75 cents, the high we see after the bounce is lower and lower. So if you draw a line from the highs, it's getting lower and lower, which probably suggests there's less support for the company. So if we see the share price get above, say, 81 cents, that might be bullish. But I probably would expect that, well, this could go, I'm not going to say anything. I was going to say I probably would expect the share price actually to break through 75 cents, and that will be a fairly bullish move, just because the highs we are seeing are getting lower and lower. There is I think this could be a descending triangle. Pretty sure descending triangles are bearish. I could be wrong. The other company related to Sigma Healthcare, because they lost that contract with Chemist Warehouse, is EBOS Group. You can see the share price dropped 15% on the 6th of June. Really big volume coming through. Nice bounce, but the share price has gone back to the lows we saw after they released, or they announced they lost that contract with Chemist Warehouse. I wouldn't be surprised to see the share price fall below this support level. I think it could be a long-term support level. Let's have a look at the weekly chart. Oh, yes, okay. So that support level was sort of created back in October last year, hit that support level on the release of this negative announcement, and then has hit that again. So I wouldn't be surprised to see the share price fall through about $32. But when you look at the weekly chart, this is a potential buy the dip opportunity. I think it all depends on your long-term views of EBOS Group. I don't have any long-term views. Just going to have a quick look at the financials. Market cap $6 billion, dividend yield 3%, price to earnings ratio 26.2. Nice increase in revenue over the last 5 years, up to $10.4 billion of revenue. Low margins, profit margin of 1.9%, which is probably understandable for this type of company. But the weekly chart looks okay, buy the dip opportunity, but the daily and 1 hourly chart look fairly negative. Now on to Max 7. This has been bullish recently. Haven't been following this company too closely recently, but you just see the share price zoomed higher from about the 3rd of July, up 19% that day, up 10% the day after, the 4th of July, and then up 8.6% on the 5th of July, and then kept going higher all the way up to 98 cents. And then we saw a big dip in share price, 13.6%. What date was that? Was that the quarterly report date? The 31st of July. and the share price has fallen straight to a support level. That support level is about 77.5 cents. So why is that a support level? So if we go back to July 2022, share price hit 77.5 cents and then pulled back. Share price hit 77.5 cents in January this year and then pulled back. Share price pulled through that resistance level on strength. Huge volume on the day that resistance level was broken. That's exactly what you want. Not only that, the share price has tested 77.5 cents about 1, 2, 3, 4 or 5 times in the past week and a half. And every single time the share price gets below 77.5 cents, we see buying coming in. We know there's buying because each of these one-day candlesticks, there's a tail to the bottom of the main body. So sort of a shadow below the main body, which tells us there is a bit of buying. So it looks like 77.5 cents is holding strong. So a potential nice little buy for Max 7 at 78 cents, where the share price is right now. Even I think if you look at the 1 hourly chart, yeah, you can see the share price is struggling. I think it is struggling now. If you look at the 1 hourly chart, you get a different perspective, and it looks like it is struggling to remain above 77.5 cents. So maybe this is one of those situations where the market is testing that support level quite a few times, and eventually it's going to break, and now share price might fall below 77.5 cents, which would be a confirmed break in that support level. Anyway, so there's many ways to view these, view technical analysis. Now it's a Magellan. Released their full-year results. Market liked it. Yeah, not much else to say about Magellan. Now, if you do look at the one-day candlestick, so if we look at the weekly chart, very bearish. Very bearish. Share price has dropped from $75 to $10. If you look at the daily chart, there is some sort of signs that maybe there is a bit of a shift in sentiment. This is the first time the share price has been above the long-term trend line. So that long-term trend is this red or shaded red area, the top shaded red area. That's sort of the long-term trend, and this is the first time the share price has been above the long-term trend since July 2021, when the share price was above $50. So potentially there is a shift in sentiment in this company. I'm not sure. Now, in saying that, there was a bit of selling during the day. We know there was selling because when you look at the one-day candlestick, there is a tail or a shadow above the main body, which means there was selling. And if you look at the 1 hourly chart, you can see when there's selling coming in. So some nice buying in the first few hours, set the share price all the way up to above $11. In the last 3 hours of trading, some selling came in, and there was a little bit of volume as well. Not as high as volume as we saw in the first 3 hours. So initially, the market loved the results, and then more than likely, fund managers came in, saw the share price get to above $10.70, and decided that was enough, and it was time to sell out of Magellan Financial Group. Net Wealth, which is my super provider. So for those who don't know, you can trade shares all through the world in your super. So I don't have a super and have to decide whether it's going to be balanced or risk. I buy individual shares throughout the world in my super. There are some limits, say to what international companies you can buy, but it's broadly speaking, it's most of the bigger companies in the world, if not all the big companies in the world. But when it comes to the ASX, I can only own 30% of my portfolio in lower quality companies. So some of those small cap companies, which can be a concern at times, but I'm okay. It's my super. I prefer to own high quality companies in my super. Now, when you look at net wealth, this is the daily chart. Share price has done nothing over the past, say, year and a half. And potentially we are starting to see a little bit more positiveness coming to net wealth. A nice movement in the share price on the Friday, share price up 4.2%. Not sure if they released their half-year or full-year results. But when you look at the 1 hourly chart share price, if it gets above $15.40, that will be a bullish move. So I've put, and some really good volume coming in. That's the other thing. Some really big volume coming in about midday on Friday, which makes me think there is someone excited about net wealth. Now, there is an ETF, I am following right now. And that ETF is VGE, which I believe is emerging markets. The reason I've started to follow this is just because it does look like this particular ETF is, or the sentiment in this particular ETF is shifting from negative to positive. And we have seen a pullback. So hopefully this is a real pullback in the share price, sort of the first pullback in a new uptrend in the share price of an ETF. So I don't own many ETFs. The only ETF I own right now is Asia, because I do think that's a little bit undervalued. And I do think Asia is a little bit underappreciated right now. My only concern about Asia is they're too highly concentrated in China, if I remember correctly. And I think maybe even VGE might be too highly concentrated in China as well. The last two companies I want to look at is an oil company, Woodside, and then a Boral company. So two hot sectors right now. So Woodside is right on, I'll move that up, right on the old highs we saw back in November of last year. If the share price can get above $39, that will be a bullish move. But overall, and my big mistake with Woodside is I bought Woodside at $17 back in October 2020, and then I sold for a nice profit, but I should have held on because I would have doubled my money. So being a little bit too impatient with Woodside. Remember at that time when oil got down, was negative for a very brief period of time? That was the time to buy these companies. Anyway, so not only, actually, look at this. This is the weekly chart. Some say technicals don't work. So if you go back further at $39, the old highs we saw back in October 2018, $39. The highs we saw back in November 2022, $39. Share price of this company is just below $39. If we go back further, no, it doesn't quite work like that. But if you look at the weekly chart for this company, share price done nothing. This is not the sort of company you own for the long term. You trade Woodside. You just see that by the chart. You bought Woodside in 2008 and you're still down. The share price is still down from when you bought. This is not the chart of a high quality company. And Boral. So this is in the construction area, construction, warehousing construction, I believe, cement, that sort of thing. So if you do look at the weekly chart, just like Woodside, I wouldn't call this company high quality. Share price all the way back from 2008 has done nothing, but you get a different perspective if you just look at some different timed charts. So the daily chart looks really bullish. It's actually in a beautiful uptrend. The company did release full year results and the market reacted really well. And then if you look at the 1 hourly chart, yeah, this looks really good. Beautiful chart. Maybe you could argue the run up after the release of the results was just too much. Share price went from $4.40 to current $5. We haven't seen much of a dip in share price. Maybe the dip we've seen the last few trading days is all we're going to see with Boral. And just look at the valuations. Price earnings ratio 35.6 seems fairly high. Anyway, and the annual report, revenue 3.5 billion, up a fair bit from the previous year, and only profit of 158 million. Not my favorite company in this sector. I probably would fancy James Hardie, maybe CSL, those sort of companies, but I definitely would favor James Hardie, would be my number one. But Boral's chart looks absolutely spectacular right now. And that is it. If you have any questions about any company I've shown you in today's technical update video, you can leave those questions in the comment section of this video. Otherwise, that's it for today's video. And don't forget, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for the video. Have a good day. Bye.